Welcome to episode 3 of the Crypto Shariah series. In this episode, we're doing something quite different. We are looking at stablecoins. What are stablecoins? How do they work? How do you assess a stablecoin from a Shariah compliance perspective? Stablecoins cannot be viewed from the same lens for every part of the world. A stablecoin which gives you a stable dollar value, it's a huge thing in economies where the local currency is undergoing hyperinflation, people are losing their wealth and value. This gives them something of tremendous benefit and utility. So the fundamental concept up here is something known as the peg. The peg is what it's all about in stablecoins. Do join us. We have looked at stablecoins, how they work, their plumbing and piping, and then we finally discussed from a Shariah compliance perspective how we understand stablecoins. Welcome to episode 3 of the Crypto Shariah series, hosted and powered by Facet. If you've missed episode 1, do make sure to go on Facet's YouTube channel and watch the first episode on digital assets and the Shariah compliance. Episode 2 was all about staking. So if you want to know what staking is, how it works, what you have to make sure for a Shariah compliance perspective, and how to make sure your return is Shariah compliant, watch episode 2. But in this episode, we're doing something quite different. We are looking at the world of stablecoins. What are stablecoins? How do they work? How do you assess a stablecoin from a Shariah compliance perspective? And what are the key things when assessing the Shariah compliance of any stablecoin? So first, let's understand what are stablecoins. This word is being used. You're seeing it online, on the news, on different social media platforms. But what exactly are stablecoins? If we want to define stablecoins in a very simple way, stablecoins are digital tokens. They're like your crypto assets, your digital assets. They're no different from that regard. However, the fundamental difference with a stablecoin is it's been designed to maintain a stable value by tying itself to an external reference. That is the key part about stablecoins. And this is what makes stablecoins different to other digital assets. So for instance, you may have Bitcoin. Bitcoin doesn't have a reference or a peg to anything else. Bitcoin is an independent, individual digital asset. Ethereum, in the same manner, is not pegged to or referenced to any external extrinsic reference. Its value is not dependent upon its redemption possibility and redemption mechanics. Rather, the value is based on market forces, supply demand, its use case, utility, and other things. But for a stablecoin, it's very different. Not are we only looking at market forces, supply demand, but we are also looking at the reference that it's tied to, the asset that it's pegged to, the asset that it's connected to. And that gives trust, comfort, value to investors, to traders, and to users of the stablecoin. So along with all the other conditions and dynamics that are already involved in the crypto space, stablecoins add an additional layer of stability. And that's why the entire focus and logic behind stablecoins was this: to bridge between the digital asset world and the fiat world, or the on-chain world and the off-chain world, in a manner where we are leveraging the stability to some extent of the off-chain world and using the on-chain technology and on-chain efficiencies, and bridging this gap and creating an asset which takes the best of both worlds, so to speak. And that's what stablecoins are all about. They are using the latest technologies anchored in legacy-based systems. That doesn't mean stablecoins have not had their fair share of controversy or commentary against the logic. There have been multiple writers, thought leaders, researchers raising questions about how safe or how stable stablecoins really are, because the entire thrust and intention behind the decentralized world was to move away from the inefficiencies that exist in the off-chain world. And if you're simply tokenizing or bringing off-chain inefficiencies on-chain, you're just exacerbating and amplifying the problem. Hence, there've been multiple question marks raised on the economics of stablecoins. Hence, a more balanced approach to thinking about stablecoins is, for sure, it's more like a bridge and transition to pure decentralized finance and pure decentralized assets, because it's giving the legacy-based systems, institutions, a window, an opportunity to engage in decentralized finance. And stablecoins could be seen as a stepping stone to that reality and to that world. So while stablecoins don't make much sense or may not be used as such for people perhaps in America, in the UK, and Europe, but for emerging markets, stablecoins play a huge role, and especially in hyperinflating economies. Having access to a stablecoin which gives you a dollar value, a stable dollar value, it's a huge thing in economies where the local currency is undergoing hyperinflation, is impacted, people are losing their wealth and value, their value is eroding on a day-by-day basis. This gives them something of tremendous benefit and utility. Hence, there's multiple ways to look at this problem. Whilst for some people this may be a luxury not required at all, and perhaps an investment not needed, and holdings which give no real additional value. For others in the world, this is a way of really making their sweat and tears and hard work retain its value. Hence, stable coins cannot be viewed from the same lens for every part of the world. Now, if you look at this particular slide, we can see that the stable coin market cap right now, currently, it's almost 300 billion US dollars in the world. That just shows the magnitude and growth of the stable coin industry and issuance. The last 12 months alone have seen approximately $46 trillion worth of transaction volume in stablecoins. In September 2025, it was over 1.2 trillion US dollars alone. In 2024, the market cap by the end of 2024 was over 200 billion US dollars. That was a 57% year-on-year growth. That just shows you the scale and the beast that we are speaking about. And in particular, the largest stable coin is, of course, Tether, USDT. That has the lion's share of the market. So before we go further into looking at how stablecoins work, how the peg is maintained, the use cases, the utility, how stablecoins are being used in the market, let's just have one quick look at the way stablecoins may be categorized and a taxonomy of money. So this slide, which you can see, it's presented by Deutsche Bank, who have categorized money in two fundamental ways. Either the issuer is public or the issuer is private, meaning that if it's a public issuance, that's typically the central bank, and it'll be a liability of the central bank. So you could have a retail aspect to that, or you can have a wholesale aspect. The retail aspect is the public money, meaning the cash that we have, the actual cash, the notes and the coins, which are minted by the treasury. Or you have the wholesale side, issued by the central bank. Then that refers to bank money or central bank reserve money, which is only accessible to banks and institutions as part of the banking system, and not accessible to the retail market or individuals. And in future, if CBDCs come, and there's wholesale CBDCs, which are central bank digital currencies, they would fit here. Just as if they were retail central bank digital currencies, they would fit under the retail bracket. So that's money from a more public issuance central bank perspective. If you look at money from a more private issuer, that's where you can start seeing how stable coins would be entering into the market, because then you could have private money issued by a commercial bank. So your bank deposits, the money that we have on our apps that we see, your banking mobile app, balance you see on your phone, that is money which is bank deposit money. When a bank is lending money, it's creating money which is bank deposit money. So that's one type of commercial bank money and one type of private money. If you look at the other side, which is away from the banking system, what other forms of money can you have away from the banking system? Then e-money or electronic money, which are various types and forms, like even in the UK, the FCA, the Financial Conduct Authority, the regulator, has identified different types of money or electronic money for that matter. You have your e-wallets, but then as far as our discussion is concerned today, this is exactly where stablecoins would fit, because stablecoins would be under electronic money, is digital money, and it's issued by a private institution. It's not a bank either. And therefore, it wouldn't fall under the commercial bank money, but it'd fall under the private issuer, which is a fintech or a tech company. Interestingly, on the same chart, you can see two things which do not fall under any of these categorizations: gold and Bitcoin. Gold is not a liability. Gold is an asset in and of itself. Of course, it can be a liability. If you are lending gold, it'll become a liability. But as far as the gold as money is concerned, it doesn't exist on anybody's balance sheet or as a liability on anyone's balance sheet. It is an asset in and of itself, and by you holding that, there's no IOU. This is the hard form of money. And likewise, Bitcoin. Bitcoin doesn't exist as debt. Neither does gold exist as debt in and of itself. Unlike bank deposits, unlike wholesale CBDCs, unlike retail CBDCs, these exist on the liability side of a balance sheet. Whereas Bitcoin and gold do not. And that's what makes them fundamentally different. And that's why there are many commentators objecting on stablecoins, because effectively stablecoins are just tokenizing the same underpinning, which is fiat, or it's just giving you a mechanism, and it's just giving an extension to the legacy world, the fiat world. It's not solving the problem which commentators have with the off-chain centralized world of finance. But gold and Bitcoin are two unique assets in that they don't exist as IOUs. They are independent assets in of themselves. If you own gold, it's not existing in anybody else's balance sheet. It's your own gold. And it's your own asset, independent. And that's what made gold a phenomenal mode of payment and currency for centuries. And even from an Islamic finance lens, it was designed and is still designated as money from a Sharia lens. That's why there's always zakat payable on gold, regardless of how you're using gold, because it has moneyness to it. The fuqaha and scholars call this thamaniya, that intrinsically exists with gold. Hence, zakat is always payable as far as the Hanafi school of fiqh is concerned. Fine, we've understood all of that. We know stable coins, what they are. We've understood some of the logic. We've looked at the numbers, the market size of stable coins. And we've also looked at a taxonomy and categorization of money and where stable coins could fit within that taxonomy. Now let's dive in a bit deeper and understand the plumbing and piping of stablecoins. How do they actually work? What's going on? So the fundamental concept up here is something known as the peg. The peg is what it's all about in stablecoins. So stablecoins are designed to hold a steady value by tying themselves to an external reference, most often a fiat currency. That link, known as a peg, is central to why people use stablecoins for trading, payments, and as perceived safe place during market volatility. The peg is maintained through economic incentives, reserves, smart contracts, and market forces. So how is this peg maintained? Remember, when we say peg, what do we mean? We mean the token is designed, this digital asset is designed to stay very close to a reference value. For instance, you have USDT Tether. It's designed to stay very close to the value of $1, meaning 1 USDT should stay very close to 1 USD. That is the peg for Tether USDT. So this stability that we are trying to maintain, or what is the main factor and drive and intent behind stablecoins, this pegging this reference is maintained effectively through a two-tier system. You have the primary market and you have the secondary market. The primary market refers to authorized participants directly trading or exchanging with the issuer. So if the issuer is, for instance, Tether, you'll have authorized participants, typically financial institutions, who will have the ability to redeem USDT, the stablecoin, for USD, dollar. That is not accessible or open to everybody. And it doesn't really have to be open to everybody. There just needs to be a redemption mechanism to support the over-pegging system. So that's the primary market, where there's direct redemption rights. And as long as people trust this and trust the issuer's reserves, and there's an ability to redeem, then this will maintain the confidence in the stablecoin and its value. The second tier in this two-tier system is the secondary market. And this is where the retail world comes in, where you and I sit. This is where you and I will be trading, exchanging, utilizing this stablecoin. That supply and demand will be ensuring the value of that is maintained towards its reference rate. So how is all of this maintained? Well, there is a trust pyramid. At the top of the trust pyramid, you have the large institutions. They are the ones who will be buying the USDT, the stablecoin, and redeeming it for $1 when the price in the market has dipped. For instance, it's 97, 98 cents. And that gives them an exchange rate profitable and beneficial for them. So that's at the top of the trust pyramid. Then in the middle, there's market makers. They are the ones who look for arbitrage opportunities, and they will be buying again where it's cheap and selling it where it's slightly more expensive, and thereby maintaining and keeping the spread as they gain. And at the base of this pyramid, it's the retail market, where we are benefiting from the anchored price that exists. So especially in those economies, markets, or on DeFi platforms where you want to use USDT or you want to finance in USDT, you'll be benefiting from the stability of the price on such platforms and in such economies. So what supports the peg itself? Well, there are multiple factors supporting the peg. Number one is institutional arbitrage access, where big players can actually redeem the stablecoin or exchange the stablecoin for the fiat currency with the issuer themselves. So if the price moves, they can either sell or buy and make a profit and a gain. Likewise, reserve backing is fundamental to the peg. What is the quality of the reserves held by the issuer? Are they highly collateralized? Are they non-collateralized? Or does it have assets which are high quality liquid assets? What type of reserves are held by the issuer? That will have a fundamental impact upon the trust people have in the value and stability of a stablecoin. And it's all about trust here, because in the grand scheme of things, stablecoin holders have trust that this value will be maintained. That value will be maintained as long as institutions have the ability to redeem, because they'll play a big role in maintaining that one-to-one peg. There's transparency and clarity on the reserves, and the reserves are equaling the issuance. Because if you have very little reserves and high issuance, then that means this issuance and these coins or assets are not backed by anything. And that will mean if there was a bank run, for instance, then people would not be getting anything back and the value would drop immediately. Similarly, market depth is just as important, because having deep order books and high trading volume shows its liquidity, your ability to exchange, your ability to open a position, close a position, own, sell, exchange stablecoins. And that really reflects the confidence in this, the ability of people buying and selling. Its liquidity reflects its demand. And hence, that also gives strength to the peg. The fourth factor is regulatory pressure. The more oversight, the more regulation involved, it makes sure issuers are managing their balance sheet properly and managing their books properly. And that then only helps and supports the peg, stability, and confidence. A fifth point, which is crucial to maintaining the peg and supporting the redeemability of one-to-one, is issuer reputation. As long as the issuer has a strong track record of redeeming and exchanging and honoring its promise, then people will continue to use the stablecoin, people will continue to benefit. The moment there is a withdrawal, or a moment there is a pause on withdrawals, or there's a lack of facilitation of redemption, that will send all the negative signals in the market and immediately impact the price. And it can heavily impact the price, depegging the stablecoin from its underlying reference asset. So if we look at this slide where we take an example of how the value is actually maintained, let's look at USDT, the institutional arbitrage loop that exists. So the peg doesn't require everyone to redeem. It only requires that authorized parties can redeem. To maintain this loop, that's what's required only. When USDT trades at 98 cents, authorized participants buy USDT on the open market for 98 cents. They redeem with Tether for $1 and they profit 2 cents per token. What's the implication effect of this? Well, they're buying pressure because they're coming in and they're buying these tokens in the market, these stable coins in the market and redeeming. That demand pushes the price up back to $1. The opposite and inverse, when USDT is trading at 102, $1.02. Authorized participants, they will go and deposit $1 with Tether. They will receive new USDT assets in return. They will go and sell that on in the market for $1.02 because that's the live price in the markets and they've made a profit of 2 cents. What's the effect of that? With this big whale or huge selling pressure coming in, that will drop the price because there's an abundance of supply or there's excess supply, causing the price to naturally come back down to $1. And this is how this arbitrage system, to some extent and to a certain degree, maintaining the value of the peg for stable coins which are pegged to fiat currencies like the US dollar. Now, we were talking a short while ago about the concept of depegging. Depegging is where the stable coin fails to maintain its value and fails to remain pegged to the reference asset. This can happen due to various factors. For instance, market manipulation. This can occur when traders or large holders, meaning whales, can push the price away from its peg by either coordinating large selling and buying, wash trading, or using derivatives to force liquidations. That will impact the stablecoin's price stability and therefore depeg the stablecoin. Another situation is when there are trust issues with the issuer. So if the market loses confidence with the issuer or the mechanism backing the stablecoin and its redemption, then that becomes a currency that doubt, once it's sown into the hearts of the people, people will begin to liquidate their positions. And this washing away an immense sale and closing positions will increase supply in the market, forcing the price to plummet. Likewise, another factor or situation where the stablecoin can fail to maintain its value is due to regulatory issues. If there are regulatory changes, meaning there's new laws in place, or there's a ban that's been enforced on the market or in a region of trading and using stablecoins, that will immediately kill the demand of stablecoins and impact the price and effectively lead to depegging, loosening of its connection with the reference rate. That's why stablecoins have vulnerabilities. And this is one of the things which commentators, writers, and thinkers object on, that the vulnerabilities in stablecoins are similar or reflect to some extent the vulnerabilities that were found and are found in fiat currencies. And that's why they are not the end-all and be-all or the ideal solution, but they are a step in the right direction. Some of the vulnerabilities, of course, include reserve quality. If reserves aren't truly one-to-one or contain illiquid assets, if the assets are illiquid, the reserves can't be sold on an exchange and honor a redemption, then that can break the peg. Similarly, if there's a confidence crisis, if enough authorized participants lose confidence simultaneously, the arbitrage mechanism will fail, which we just discussed earlier. And that's exactly what happened with Terra, UST, where confidence was completely lost. Authorized participants were not able to continue with the arbitrage mechanism, and that crushed and destroyed the pegging and pricing of the stablecoin. A third vulnerability and risk is the legal and regulatory risk. If a stablecoin issuer is facing regulatory action preventing redemptions, the peg mechanism breaks entirely. There is no peg mechanism left because you are unable to redeem. And therefore, this asset is no longer a stable coin. There is no redemption to anything. And of course, the final possibility when it comes to vulnerabilities is a bank run. You can have all the reserves, you can have a lack of legal regulatory risks, but the moment there's a confidence crisis or a bank run dynamic where people now want to redeem or multiple parties want to redeem their underlying asset, then it can destabilize the entire stablecoin and depeg this very asset. So as long as people don't redeem, or large people don't redeem everything, confidence remains. The moment where there's over redemption and there's excess liquidation, that will send the wrong signals in the market for people, and that can cause a confidence crisis in the underlying asset. So to summarize the discussion on depegging, if we look at what is depegging in crypto, despite the mechanisms to maintain a peg, stable coins can lose their peg under certain conditions. A stablecoin is considered depegged when its value drifts away from the asset it is supposed to mirror. This can happen for several reasons: market shocks, a sudden market downturn, or loss of confidence in a stablecoin's issuer can cause panic selling, leading to a loss of the peg. Insufficient reserves. If a stablecoin issuer does not have enough reserves to back the token, it can collapse the token's value. This has been a concern with Tether, which has faced accusations of not being fully backed by actual dollars, and a lot of work has been done since such accusations. Number 3, smart contract failures. Algorithmic stablecoins rely on smart contracts to regulate supply. If these contracts fail due to bugs or malicious attacks, it can lead to instability and depegging. And number 4, external factors, regulatory changes, losing access to banking services can also lead to depegging. So these are multiple factors and conditions which can cause this depegging. Let's now look at the types of stable coins that exist, because the types of stable coins that exist are directly related to the type of peg it has. Stable coins, as far as its collateralization is concerned, can be categorized into 4. Either it's fully collateralized, meaning it has a one-to-one backing with an asset, whether that's a fiat currency or something else, it's fully collateralized. Or it can be over-collateralized, where there's a surplus of collateral. Typically, that happens when digital assets are being used or other cryptos are being used to over-collateralize a stablecoin. The excess collateral is then used to absorb any price fluctuations and make sure stability is maintained and that pegging is held. Number 3, you have a partially collateralized stablecoin. Such stablecoins are backed by a portion of the reserve assets, often supplemented with other mechanisms like algorithmic controls to maintain the peg. So you may not have 100% reserves backing 100% of issuance. If you have 100 million stablecoins issued, you may only have 50 million, 60 million worth of assets, and the remaining and surplus and the difference is maintained by other mechanisms. That's a partially collateralized stablecoin. Number 4 is the non-collateralized algorithmic stablecoin. These do not have any underlying reserves or assets or collateral backing them. Rather, algorithms and smart contracts are used to control the supply of the stablecoin, expanding or contracting based on demand to maintain a stable value. And those are pretty few and far in between. There's not many such examples in existence now. Majority of stablecoins are pushing towards either being fully collateralized or overly collateralized. So that was a categorization and taxonomy based on understanding collateralization, the amount of reserves. This particular slide, we're looking at what type of reserve assets can exist. You can have fiat collateralized stablecoins, where the reserves of fiat currency back these stablecoins. Examples include USDT, Tether, USDC, and TUSD. These are typically backed by reserved, held in banks and high quality liquid assets. The second type is commodity-backed stablecoins, where these stablecoins are backed by tangible assets such as gold or oil. A prime example is PaxG, which is backed by physical gold reserves. So each PaxG token represents 1 fine troy ounce of gold. You can have crypto collateralized stablecoins, where these stablecoins are backed by other crypto assets rather than fiat. So for instance, DAI, it's a decentralized stablecoin that is over collateralized by Ethereum. And so the logic and game plan there is the value of DAI is stabilized by keeping more currency in reserve than the value of the stablecoin issued. You can have algorithmic stablecoins, which we talked about and touched upon earlier. These stablecoins use algorithms and smart contracts to regulate the supply of tokens. Luna and Ampleforth are examples of algorithmic stablecoins. Finally, a fifth type, which is a hybrid, that it may be having some commodity, some fiat, some crypto mixed together. So these stablecoins combine elements of collateralized and algorithmic models to maintain their peg. So these are the different types of stablecoins as far as the reserve assets are concerned, and from that perspective. Stablecoin use and utility can be summarized into 4 different use cases. Number 1 is savings and hedging purposes. This is especially for markets and economies suffering with high inflation, currency controls, or banking instability. For them, having a digital dollar operates like a saving vehicle. So users in the retail market will be converting their local currency into USDT, for instance, a digital dollar, and maintaining the value of their hard earnings. It'll act as a hedge then against a local currency, and it's a way to hold value outside the current system that they're operating in. That gives them inflation hedge, accessibility and inclusivity to the wider world and markets, portability and security. If they're traveling, they can keep these funds and maintain their value regardless of where they are in the world, and it helps them with everyday transactions effectively. One of the primary use cases is, of course, DeFi and digital ecosystem payments. This is still one of the highest use cases of stablecoins, where USDT or other stablecoins are the core unit of account and settlement asset on exchanges and DeFi protocols. This allows investors and traders to enter and exit such protocols, such exchanges seamlessly. And it also helps them maintain their assets on chain without taking or off-ramping their assets and converting them back in fiat currency. So you can almost maintain a wallet of USDT, which would be for the trader as good as holding a US dollar account with a bank, and without the need of redeeming or exchanging and exiting your position or exiting and liquidating your holdings every single time. It'd be as good as holding a savings account or a checking account or a current account with a high street bank for many of these traders. From a more institutional perspective and from a more corporate perspective, there's use cases for stablecoins to act as treasury and cash management options, because corporates are increasingly now looking at stablecoins for working capital purposes and liquidity buffer. So that can help them move funds, assets, money between different entities, platforms, and jurisdictions faster, quicker, and more efficiently. So for instance, if they want instant liquidity, that can be given to them outside the traditional setup, because the cutoff times and banking hours wouldn't allow them this near instant payment, whereas that can be accessed and achieved through having the stablecoin that is pegged one-to-one with the dollar. That will of course help them then with a faster deployment of surplus cash and more flexible intra-group transfers, as well as granting them access to dollar liquidity in non-dollar jurisdictions. A fourth use case for stablecoins is cross-border payments. This is true for many digital assets where they are being used for remittance purposes and cross-border payments because of its settlement time. Transaction fees are less in comparison to off-chain legacy-based systems. There's capital efficiency, there's transparency because there's visibility. So these are a number of use cases that are seen for stablecoins, with savings, of course, being a fundamental use case and utility for these assets in emerging markets and economies where inflation is really high. Hence, McKinsey and Company have developed this snapshot of benefits of stablecoins. When you're comparing stablecoins to legacy payment rails, you can see when you're looking at the speed, in the legacy system, if it's 1 to 5 business days of processing time, then stablecoins is near instant settlement. If you look at cost, then the legacy system, there can be anything from $15 to $50 per transaction in international wires. Credit cards can be 1.5% or 3.5% of transaction fees. Clearing houses can charge $0.2 to $1.5 per transaction. Whereas if you look at stablecoins, typically it's less than 10 cents per transaction. The cross-border difference is visible. The legacy system relying on correspondent or domestic banking systems, and there's additional foreign exchange fees. If you're looking at stablecoins, it's borderless, it's minimal, and almost non-existent FX fees. Automation and programmability. Legacy, again, it's manual. There's settlement frictions, there's limited APIs and programmability capabilities, whereas stablecoins are fully digital, smart contract enabled, and high programmability. Security. The legacy system has established banking standards, employs technology to mitigate fraud risk, whereas the stablecoins cryptographically secure and have irreversible but catastrophically vulnerable to wallet or key theft risk, which is a reality. That's where the legacy system has an edge, perhaps over the stablecoin setup. Transparency. When it comes to the legacy system, there's limited visibility into transaction steps. Stablecoins, on the other hand, have fully transparent transaction reporting on blockchain. Settlement risks, when it comes to the legacy system, intermediary or correspondent dependency risks, whereas stablecoins is peer-to-peer with no intermediary risks. Availability, as we mentioned, stablecoins are 24/7, 365, and legacy payment rails are, of course, restricted and limited to banking hours and constraints of days. If it's a public holiday, nothing's going to happen. This slide just gives you a snapshot of stablecoin transaction volume in 2024 and the transaction count breakdown. So you can see majority of transaction was in crypto trading. Now remember, when we're talking about crypto trading, whilst it refers to or includes exchanging, arbitrage, buying low, selling high, or just looking for opportunities, it would naturally also include people who are buying USDT in emerging markets and high inflationary economies to preserve and hedge against their risk that they are facing. 4% was on-off ramping, and as you can see, the numbers decrease when it's tokenized RWA, real-world asset settlement, peer-to-peer payments, B2C, C2B payments, or B2B payment systems. The question arises, how do then stablecoins work and the business model of stablecoins? If you have an issuer, what's the benefit for them? How do they benefit? So stablecoins typically work in this manner. A customer will deposit an underlying asset, typically US dollar, with a stablecoin issuer, and in return, the issuer will mint or create an equivalent amount of stablecoin on a blockchain and delivers it to a customer. So they could have smart contracts on Ethereum or Solana, and they issue stablecoins on those blockchains. The US dollar cash given to the issuer then is parked in what are called reserves, which are typically high quality liquid assets like US treasuries. Of course, then when the issuer places these dollars in high quality liquid assets or treasuries, for instance, they are earning interest there. That's how they gain. So they're earning from, like a bank, they have liabilities really, and they are investing the difference or investing their assets right now with treasuries and earning interest on that. So stable coins can also trade on the secondary market where prices can fluctuate with supply and demand. That's number one. What happens in number two then? Stable coins are typically stored in cryptocurrency wallets. These wallets hold the stable coins as digital assets on the blockchain, which records who owns the coin and any transactions they make with it, allowing users to send, receive, and manage their stablecoins. Number 3, customers can use their stablecoins to transact in a variety of ways. When a customer initiates a transaction, they send a request to the blockchain network that includes the recipient's wallet address and the amount of stablecoins to be transferred. The transaction is verified and recorded on the blockchain. The transaction is then reflected in the recipient's wallet balance. And at the end of that whole chain and process, when a user wants to redeem their stablecoin for the underlying asset, they send the stablecoin back to the issuer. The issuer then burns or destroys the stablecoin, the digital token. It burns the token itself, removing it from circulation, and releases the equivalent amount of the reserve asset back to the customer. Now remember, when that is happening, that's typically authorized participants only, institutions which will redeem, just say, $100,000 worth, $50,000 worth. So if you go on Tether, for instance, they will have authorized participants who will have a minimum ticket size of just say $50,000, $100,000 before they redeem and exchange anything. So not everybody can access that functionality. If we look at USDT now as a case study, Tether Limited runs a central ledger of who is owned what in fiat and in tokens. To get USDT, a customer, usually an exchange or institution, opens an account with Tether. There will be KYC, AML. They will wire fiat currency, typically USD, to Tether's bank account. Tether will mint USDT on one of the supported blockchains, Ethereum, Tron, or Solana, and sends it to the customer's on-chain address. Now, Tether has its own mechanism behind the scenes where it uses multi-signature or multi-sig wallets controlled by the team to authorize the issuance of new tokens. They create what they call authorized but not issued USDT in Tether's treasury wallet, and only upon authorization do they release the assets in batches. This is all happening in the on-chain preparation where there's an authorization of tokens, where the tokens don't enter circulation just yet. They remain out of the total circulation supply. Only once things are verified does Tether call the smart contract privileges and issue mint tokens and transfers these tokens to the customer's wallet from the treasury account. It is at that point that tokens are increased in terms of supply in the market. And then the reverse happens when there is a redemption. The customer, meaning the authorized participant, will send USDT back. Tether will burn it and wires out the fiat. So tokens are created and destroyed on-chain, but decisions about how, when, what are entirely off-chain and centralized. Considering everything that we've discussed, stablecoin issuers face something known as the Stablecoin Trilemma, which is you can get 2 out of 3 things at the most if you're looking for price stability, decentralization, and capital efficiency. To get all 3 in one go is near impossible because there's always a trade-off based on what you choose. If you go for a fiat-backed stablecoin with central bank money or high-quality assets, this will give you the strongest price stability as far as stablecoins are concerned. But they are centralized, and the capital efficiency will depend on the quality and risk of the backing assets. If you have a crypto-collateralized stablecoin, they will need heavy over-collateralization, but you've received decentralization and you may have efficiency. If you opt for an algorithmic stablecoin, you may have decentralization because you're using digital assets here as your reserve assets. But there is a high risk of price stability. So you at best will receive decentralization and capital efficiency, but not really attain price stability. Hence, this trilemma is an issue for stablecoin issuers. Hence, if we look at the typical stablecoins in the market right now, you have USDT, USDC, USDE, and if you look at their underlying assets, all of them are pegged to the US dollar. Some of them will have a mixture of assets, but one thing is in common with all of them, with all these different issuers, is they're typically using Ethereum. Some are using Solana. One is using XRP, Ripple, but the landscape is very similar in that majority of them are doing fiat collateralization, and they are fiat-backed stablecoins, which gives them price stability, efficiency, but where the loser is decentralization. They are still centralized, and therefore it's an extension of the fiat world in digital asset form. Hence, from an issuer perspective, there are different models at play. If you're looking at the business models of stablecoin issuers, there's typically two ways and two types of business models. You have the outright issuance solution, where the issuer will mint its own branded stablecoin, like your USDT or USDC. The end customers in that scenario are sending directly to the issuer, these authorized participants, and receiving USDT, and the reverse is happening when there's redemption. The white label solution is somewhat different. The issuer is now minting a stablecoin not for its own accord, but for its client, who will then be, or for its partner, who will then be the public facing or the brand, so to speak, like your USDG and PYUSD. That's what's happening there. So there's a different business model. The economics are also different. The risks are different for all the parties here. One thing to understand here and to highlight, a stablecoin issuer is not just holding customer funds. It's effectively running a balance sheet because it's promising par redemptions, it's managing reserves and liquidity, and it's facing a classic bank-run risk. Therefore, its business model is very bank-like. And the revenue model is actually narrow. It's narrow banking because they are only earning yield on the reserves. And without a very large market cap, the yield after fees, partners, and compliance can be very small to sustain the business model and the business itself. So this is not really a lightweight fintech app or wallet in any regard. It's much more like a heavily regulated, capital incentive, low margin, liquidity sensitive, bank-like institution with a token front end. That's exactly what you are doing when it comes to stablecoins. Of course, because stablecoins are digital assets, we always need to review stablecoins as whether they fulfill the criteria of being mal and property. Do they exist independently? The answer is yes, because they are an electronic record which can transfer from wallet to wallet. So they have an independent electronic existence, a digital existence, which is similar to all your digital assets, whether it's PDF files, data, or anything else for that matter. Any intangible digital asset is similar. So they have an electronic existence which can be transferred from one person to another person. They also have utility use cases, which we've discussed, and therefore they have this natural economic interest or economic value that people seek and people want. This is the most important part of a stablecoin, because if a stablecoin is not deemed to exist independently from its reserves, then what is the difference between a stablecoin and a derivative? And that's perhaps the most important point. Because of its independent existence, because of it functioning separately, in that what you're trading now is an asset in and of its own right, on its own accord. Yes, its value is being maintained with a reference, with a peg, and that value is based on redemption and a promise from the issuer. But this asset now is functioning independently in markets where the underlying asset can't function. So a USDT, for instance, it will be operating in emerging markets where dollar is not a local currency. That doesn't mean dollar can't be used. People may accept dollars and may use dollars, but it is not the asset there. But USDT can work there. People are saving in USDT. People are accessing USDT. And USDT is an easier way. It's another way, which for them is a dollar equivalent. So USDT has a separate existence to dollar. These are two separate things. Because they are two separate things, one is not a derivative of the other. Rather, it's an independent asset which has its own use cases as functioning separately, and people have value in this, trust this, based on the promise of redemption that exists with the issuer. So that's why stable coins are not derivatives. A derivative, whatever it is, it's not an asset in and of itself from a Sharia lens. Rather, it's connected always to the underlying, in that it's an option. You have the right to buy, the right to sell the stock. It's a swap, for instance, or it's a forward or futures agreement. These are just contracts based on the value of something else. USDT is not that, and stablecoins are not just contracts. They are assets functioning in their own right in different markets, giving different use cases, utilities to their holders and owners. And they exist independently. of the underlying asset. That's what makes stablecoins different from derivatives. Another thing which we must check is the use case and utility of stablecoins, because that's a Sharia compliance test and check, which is captured under the concept of taqawwum, being mutaqawwim. Something must be having value, halal value. And majority of these stablecoins have that value because they are just used as a mode of payment, a means of exchange, or a savings and hedging mechanism. So typically the use case is Sharia compliant. Third point is, if a authorized participant is redeeming the stablecoin and they want to redeem and they want to exchange the stablecoin and get the underlying asset, then that redemption should equal a Sharia compliant asset. It can't be that you're redeeming and you're receiving a bond, for instance, or an interest bearing asset, or you may be receiving gold, which is absolutely fine. So the redemption must be to a Sharia compliant asset. Hence, when we're looking at stablecoins, there's really 4 areas that can be looked at. You can look at the reserves, you can look at company operations, the reference asset, and you can look at the stablecoin utility and use case itself. If there's a stablecoin which does not have Sharia compliant reserves, does that mean the stablecoin itself is not Sharia compliant? That is not the case. Because the moment you've deemed and regarded the stablecoin to be independent from the underlying reserves, then it's really equivalent to your typical currency, because banks are doing a very similar thing. When they issue bank deposits, private money, they are at the same time holding other assets in non-compliant holdings, interest-bearing assets, yet they are issuing a fiat currency. Or another way to look at it is the connection and whoever's earning on these reserves is not you, the stablecoin owner. It's the issuer themselves. They are just issuing this because of their size and their ability to issue. They've issued this, but you're using the stablecoin in Sharia compliant ways. You are not earning any interest on this. It's an independent asset. It's pegged 1-to-1. The only promise that you have is a $1 conversion rate, a 1-to-1 conversion rate. That's all. But there's no interest being paid. There's no benefit of anything the company is doing. That's why this is it is a sale. The company is selling you the stablecoin and you're buying the stablecoin. They're taking your dollar. They're doing what they want with the dollar. But that's on their balance sheet. That's their action and their activity. It's not your activity. Of course, that's not the most ideal solution from a Sharia compliance perspective. And that's why in the next slide, we look at the ultimate Sharia compliant stablecoin. But if we were to just look at it technically speaking, then we cannot deem a stablecoin as non-compliant solely because the issuer, on their own accord, on their own balance sheet, separate from you, are doing non-compliant activity. So there is a question mark on reserves, but that does not necessarily impact the asset itself, because the asset is not the reserve, and what the company is doing is not what you are doing. 2 separate things altogether. They've sold an asset to you. You are the owner of this asset. They are the owner of their assets. What they do is with them. What you do is with you. From a Sharia compliance perspective, at a stablecoin and the issuer, and you wanted to build out a Sharia compliant stablecoin through and through, end to end, you'd want the operations to be Sharia compliant of the issuer. You'd want to make sure that the issuer is dealing with Sharia compliant assets. It has a proper framework of minting, of burning, of issuing, of managing, of operating, of exchanging, of trading. All these different facets and aspects of the stablecoin life cycle and journey would all need Sharia regulation and Sharia guidance and controls, ensuring that where they invest, the reserves they invest into, the conversion, the redemption, all of these things are Sharia compliant. The third thing would be looking at the reference asset. We would need to make sure that the assets held by the issuer are all held in a Sharia compliant way. One is the asset itself. What is the asset? It can't be then bonds. It can't be anything of that nature. It'd have to be something like gold, for instance. And likewise, a contract. You can't have a forward contract or a futures contract in gold. You would need to be owning the asset itself. So the asset plus the contracts which give you access to the asset would have to be viewed from a Sharia compliance perspective. And finally, if you are looking at a stablecoin from a Sharia lens, we'd want to review and understand the use case and utility of the stablecoin. If there was ever a stablecoin designed to function solely in a non-compliant way, that would be non-compliant from a Sharia lens. It would not be a compliant stablecoin because the use case and utility is embedded in the coin for non-compliant purposes. But majority of stablecoins, if not all, the idea and intent is to function as a fiat extension or a digital fiat token, and therefore just operating as a savings mechanism, hedging mechanism, payments, B2B, B2C, and DeFi trading, for instance. If you look at then the vast majority of stablecoin reserves, they are held, of course, as USD treasuries, repos, money funds, and deposits. But as I mentioned, that does not mean then USDT as a digital asset in and of itself will be non-compliant, because the token itself, or USDT, the stablecoin, is completely different from the issuer and their balance sheet and what they are doing in terms of their asset side of the balance sheet. How they are earning, how they are gaining, it's got nothing to do with you. You are a separate counterparty, an individual, which has no benefit from the asset side of Tether. So if we were to build an end-to-end Sharia-compliant stablecoin, it would have to be looking something like this. We'd have to create a stablecoin which has only Sharia-compliant assets in its reserves, nothing else. The operations, as I just mentioned a short while ago, would have to be all Sharia-compliant in the way they operate, they manage, fund, contract, regulate, control. All of that would have to be approved from a Sharia scholar or Sharia board or a Sharia advisor. Reference asset itself, what is it pegged to? Gold, for instance. It'd have to be Sharia compliant. It can't peg and reference and have a one-to-one redemption with something non-compliant. So the redemption has to be to a Sharia compliant asset. And finally, the use case and utility must be Sharia compliant also in order to create the ultimate Sharia compliant stablecoin. Thank you very much for joining us on episode 3 of the Shariah Crypto Series, where we have looked at stablecoins, how they work, how they operate, the plumbing and piping behind stablecoins. We looked at different examples, case studies, use cases, and then we finally discussed from a Sharia compliance perspective how we understand stablecoins. I hope this was of benefit to you, and do join us on the next episode of episode 4 in the Shariah Crypto Series, where we'll be talking about zakat and crypto.